Howdy, Jacob here. Today we're looking at Astrana Health in the healthcare providers and services industry. 1.8 billion market cap, essentially the same enterprise value. Looks like they were incorporated in 1985, and they're a physician-centric, technology-powered healthcare management company that provides medical care services in the U.S. Okay. Growth has been very astronomical, 10 million in 2014 to 1.4 billion in 2023. So huge growth. Return on invested capital even recently with their increased gross and operating margins are still high single digits, so nothing really crazy impressive there. Balance sheet shows 294 million cash on hand with just 20 million short-term debt and 259 million long-term debt. So they do have enough cash on hand to write off all their short-term and long-term debt. So we're definitely not concerned with the balance sheet. Cash flow statement shows good production of free cash flow with heavy reinvestment, both through acquisition and reinvestment, which we can see through their capital expenditures growing from really zero to 29 million in the most recent year. And free cash flow or cash from operations also growing very heavily, with use of cash being a bit on acquisition, a little bit of share repurchases, and then their dividend. Looks like they do a one-time dividend because I don't see their dividend on Yahoo Finance. So I might just do one-time special dividends, just kind of consistently, just everything that they produce from free cash flow. They spend a little bit on acquisition, spend a little bit on share repurchases, and then the rest they might just give out in a dividend. I kind of like that way better than having a consistent dividend. Obviously, if you're retired and you care about free cash flow, then that's your focus, is just being consistent on the dividends that you receive and increasing those each year. But for companies that are really trying to be the most effective with their use of cash, it does make sense to me to just hand out a special dividend and say, hey, we found nothing else to do with this money. We don't think that, there's the most advantageous thing to do. So let me just give it to you through a special dividend. I kind of like that. But it does look like they got into debt a little bit for some of those projects, whether that be through just paying their dividend or making some of these reinvestments, acquisitions, and stuff. So I'm not too mad about it because, again, their balance sheet has more cash on hand than debt. So I'm really actually kind of fine with that. But let's just get to making some assumptions here. So I'd probably be a little bit more conservative on this revenue growth. They did have a negative growth year from COVID, but even the last 3 years have been very astronomical. So I probably wouldn't be surprised if they were to grow 15% a year. And then margins are not very impressive, but I do like that free cash flow is really consistently higher. So maybe let's do 4.5, 5.5. I still think they're trying to find their ways of getting solid production of cash flow and earnings, because cost of goods sold is a very heavy portion of their business. So their gross margins are a lot lower than a lot of the other good companies that we look at who, a tech business is closer to that 60-70 range. But I mean, even still, you can have a great business through this. And then on the share change, they are issuing quite a bit of shares. It must be through stock-based compensation, I guess. So it looks like they're relatively flat for me, what I'm seeing. So I'll say relatively flat. Maybe with their purchasing, maybe their acquisitions they're paying with a little bit of shares. That's the only thing that I could see that could be happening here through increased shares, because, I mean, they're worth $1 billion. So 10 million, 18 million would be 1%. And they are issuing 18 million, but then they're buying back, almost half that. So that's just 1%. We're saying, 2, 3, 5, 19%. So maybe just increase that 2% just because there's some going on that I'm not seeing. But this is assuming shares relatively just buying back what their stock-based compensation is. And then it is a 15% growth rate per year for the next 7 years. But this is, that's probably 20% the next 2 years, maybe 16% the next 2 years, and then maybe 10% years 5, 6, 7. So, there's still going to be heavy growth. Maybe we're comfortable with 25 at the end of this period. But their reinvestment rate, okay, I'm breaking this down to 22. So again, this is definitely the art of investing, and the terminal PE is very important to the valuation. But it's definitely tough for me to think about businesses at the end of 7 years that have a lot of growth, because you have to think if they're growing 15% a year for the next 7 years, then they're going to be doubling. Um, I mean, let's see, Eagles 1.15, the power 7. They're 166% greater than what they already are. What's the market for where they're at? I mean, I'm just skeptical of the things that they could do at the end of 7 years, which is why I kind of hesitant about a higher PE. And the return on invested capital was not very substantial. So although I know they're growing, a lot of their costs are going to that cost of goods sold line. And I just think that I'm still comfortable with this PE because their growth rate, but I wasn't comfortable with that 25 because their ROC is just not very impressive, and they haven't been. Yeah. So the reinvestment rate just isn't that impressive to where I want to give them a higher one. But even still, drop 34% to get to the return I'm looking for. It's really not astronomical. It's definitely possible. You know, the range that I've seen for most companies in a year are about 40%, give or take. So, I mean, definitely reasonable assumption, and I think it's a good business, but just not quite at the price. But I think we're close. So, hope you enjoy the video and have a great rest of your day. Thank you.